Okay, sounds good. Well, we're going to talk about something that has been around for a long time. So instead of talking about the future and what's next, which is, of course, very, very exciting, I'm going to ground us in a very, very old business. Anybody here has heard? Can you please get the slides move, advance? One more, please. One more. Okay, let's stop there. Have you guys heard of private credit? Only half of you? Okay. Can I see the next slide, please? Private credit gets a lot of attention in the media. But what I wanted to just share with you is that that's a very, very old business. It's a very simple thing. It's basically just borrowing and lending. It's that simple. And it's been around for thousands of years. Banks are the new kids on the block. Banks are the ones that added all this red tape, bureaucracy, and are heavily regulated. And now we're talking about it in the media as private credit is something new. And yes, banks are failing and stepping back, and that's where private credit comes in. Do the next one, please. So, have you guys seen these things, or is it just me being so biased and looking at all this private credit all the time? I think I've had 30 conversations today and yesterday combined when someone is asking what we do, and we say we're in private credit, and said, oh, that's really risky, isn't it? It's like, okay, let's peel back the onion a little bit. It depends on what you're lending to. It depends on what you're actually doing. It can be. This one here, for example, is if you lend to a software company and you expect that software company to be able to pay back that loan based on revenue streams they have from subscription from their customers, when their customers no longer want their services because they're being completely obsolete by AI, then the underlying ability to pay back goes away. That's pretty risky. Let's look at the next slide, please. It's estimated that the private credit market right now is about $3.5 trillion. Half of that is lending to corporations, mid-market companies, a lot of SaaS companies. What we do is we do the real estate debt. Very, very different asset class altogether. And why is there such a resurgence on this? Because banks are regulated. They need to withhold capital for money they're lending, meaning they can't lend their full balance sheet. There is internal pressures in addition to the regulatory. We saw that with Silicon Valley Bank collapse a few years ago. They cut back, commercial real estate kind of burnt, they were stepping back. But most importantly, the borrowers need a trusted partner. So anybody in here has ever had a good experience trying to get a mortgage or dealing with a bank as an individual? Okay, I didn't think so. I've never met anyone who's found that being pleasant. We're also seeing a lot of refis coming up where banks actually did lend at 80% loan to value, and now they have changed, so now they can only do 60. That's a 20-point gap of loans coming into maturity right now. Last year, this year, next year, next year. That needs to be covered somewhere. So the investors are actually using private credit because you can get equity-like returns. I was at one of our banks the other day, and I was working with a banker, like old and slow, and there was a poster on outside of Colin's door there, and I said, really? 4% high yield savings. What are the rules? How you lock it in for like 2 years and you get 4%. It's like, ooh, what was the latest inflation data? Well, that was 4%. How can you call that high yield? High yield must be in the teens or higher if it's going to be called high yield. Investors are looking at private credit because you can get that kind of return, but you yet don't have the equity risk. Because this is predictable. It's a structural agreement that you have between the borrower and the lender. You have to pay back over a certain period of time with some preset conditions. That's very attractive to investors. And Since this is still considered something new, it means most people that are getting into this now are doing it for a diversification play. They're reducing their concentration in whatever assets they're holding. I've had 4 conversations just this morning with real estate investors like myself, where they're seeing, well, I can't get cap rates in the teens. One person literally just told me right before this, started making me laugh a little bit. Yeah, I got a call this morning from one of the tenants and it was a leak again. You want to diversify from it, what we're seeing. But the other thing that is really strong here, and I think I touched upon it a little bit earlier, is that when you are actually having an asset-based loan, you have structural protection. That's why banks don't lend 100% on a mortgage as well, right? There is a down payment. There is an equity. If things go south, the equity is being wiped out way before the creditors are seeing and feeling the pain. This is why investors are moving here. And I try to create a very simple framework. If you can do the next slide, please. How do you assess this and how do you start peeling back the onion? How do you approach private credit? It's a little bit weird that it is almost like an asset class when it's just borrowing and lending. But first, understand the underlying asset that you're lending to. If the underlying asset is something that is in high demand, you're probably pretty good. If it is a future revenue stream from a business that is being replaced by AI, maybe not so much. I don't think that a single family home in Kansas where they're sitting and talking about baseball practice or church, having breakfast, is the same asset class as an overvalued SaaS company that is being replaced by AI. Those are not the same investments to me. So that's number one. And when you're doing a comparison here, look at the risk-adjusted returns. If you can get 15, 20%, but you have protection, maybe that's better than having a hockey stick prediction that you're investing in a company, and if a lot of things go right in an unpredictable world, you're going to get a handsome return 7 years down the road from now. And there's been also, this is also, I think, just media loves this story, the liquidity. When you're investing in equity, it's typically 3, 5, 7 years promised, and very seldom does that even materialize. It's the same thing when you're actually lending money. Many of these vehicles, you just have to understand what it is that you're signing up for. And there was so much media attention about the liquidity crisis. You can't just take your money out. It's not an ATM, right? If I'm lending you money and you're building something with that, I can't just come back the day after and say, you know, I changed my mind. Can I get my money back? It just doesn't work that way. And if everybody wants out of something where you have locked it in for 2 years, yeah, that's when media loves to have that kind of cry wolf. But if you compare it again to equity, you can't get anything back at all. So that's the framework, understanding the underlying asset, look at the full risk-adjusted return, and understand for how long you're locking up. Okay, let's move on. Can you flip 2 slides, please? This is our family office and how we look at it. We have a quarter in real estate. Real estate is great. Capital preservation, people's going to need to have a place to stay, but we're not really making a whole lot of money out of it. It's good. It sits there. And we have a very specific thesis on what kind of real estate we want to buy. We think we do it the right way, but who knows? Private credit is our biggest holding. Been doing this for 10 years, various different asset classes. That's what we learned, where the highest return and the lowest risks are from our perspective. We also do a little bit of angel investments where we actually help fund companies, only where we can be accretive. I'm not suggesting that this is some kind of model portfolio. This is our office, but what I'm saying is that private credit should be considered in your portfolios. and you need to be intentional with this is. Let's look at a couple of slides here in pretty fast succession. Look at all the different asset classes and look at them in terms of what income can they provide, can they grow the capital, how volatile is it, and how liquid it is. This is something that's very good. This is kind of just a framework for understanding as you're building your portfolio, like we talked about, right? Let's look at the next slide. These are 4 charts. I know it's an eye chart, it's by design. The black line is our fund, Steady Eddie, tracking at 20% net to investors. I have to say that past performance is not a guarantee of future performance. That it's said on the record. But we can look at the stock market, the bond market, and real estate appreciation over these years. This is 40 years. 13%, 6%, 4.5% versus 20%. Next slide, please. This is pretty astonishing. If you would have invested $10,000 40 years ago, that would have been almost $15 million today. The same 10K in real estate took your property from 10 to 60. It's not bad. The stock market, the same investment, same time, at a 13% average return, actually picked a time when it was actually more fortunate for the stock market, but still illustrate the point. That's $769,000. I take 15 million over $769,000 any day. Next slide. So what I wanted to do is share with you what we do, and it's just to whet your appetite. It's not necessarily a full pitch, but we are reallocating more and more into this. The Valhalla Income Fund is an extension of our own office. Next slide, please. Next. Remember the first part of where you want to allocate to something that is in demand. We lend money when the underlying asset is residential real estate in Middle America. That is not speculation. That is normal, hardworking families needing a roof over their head. And we're doing this in towns where people actually want to live. There are many places in Middle America that is very popular, where there's a net influx of people coming there. There's a shortage of housing. And the other thing with business is that if you can be somewhere where you have very weak competition. Caitlin, my partner, often jokes sometimes, and her 10-second answer to, what's your value proposition? Well, you suck less than banks. It's kind of true. Banks don't show up. Banks and credit unions do not lend to small-town developers and landlords. They don't participate. The real estate lenders, the national ones, they don't care about a $200,000 loan in Wichita, Kansas. It's not big enough. It is for us. We do hundreds of them, spinning like this. We have never lost capital. Never. We're on our 3rd year. We do asset-based lending, 30% equity position. The developers are offering a personal guarantee. Next slide, please. We are racing for this. We put in $2.5 million of our own money into this, and I have, throughout actually my whole career, but especially the last decade of doing a lot of direct private credit, never seen anything quite as, with a risk-adjusted lens to this, so rewarding. We're offering our investors a 12% pref paid out monthly. So every month you get a 1 point, and then we split the upside. I don't want to make money if we can't at least give our investors 12%. And the other thing here is that this is immediate. We are cash flow positive. We are doing this. We're just raising more capital so that we can go to more towns in Middle America. It's a geographical expansion that we're funding. Next slide. And we can have a longer conversation about the exact structure of how we're lending and how we actually can produce these kind of returns. But first of all, this is what we do. Our customers come back to us and borrow more and more. They don't have a lot of alternatives. And someone says, oh, if you're going to give that return to investors, are you charging them like 30%? No. There are ways to structure this in a very, very clever way that is a win for everyone. Couple of points up front, personal guarantee. 70% loan to value, 12, 13, 14%. We're underwriting in 10 days. That's the value. You can get the deals done and go make money on your business. The loans that sit on our balance sheet are 6 months in length. The question was, how long is the loan? I can't take too many questions because I'm getting minute warnings up here and I want to make sure I relay the full story. Love to talk to you much more about this in more detail afterwards. But the velocity of capital is really what you're alluding to there. We recycled so much capital so fast. Next slide. And we talk about risk-adjusted return, right? Everything is risk. We manage it primarily through three things. First of all, everything is backed, again, by a house, a normal house that people are going to fight tooth and nails to stay in. This is not a speculative real estate development on a golf course with someone's third home. It's home. Pooled capital. We've been doing it ourselves, and I've done a lot of direct underwriting deals, and we've talked about this. I'm glad we've been lucky, but when you're doing hundreds of loans and you're following exactly the same model, the same underwriting all the time over and over again, you don't have individual project risk because you're one of many. And the short durations. So we do two kinds of lending. One is what sits on our balance sheet. That is 6 minutes. Sorry. That was a weird slip. I just got minute warning here. That's 6 months. We're not quite that fast. And the other is loans that we do to landlords. And landlord loans work like this. We underwrite a property, or maybe up to 10 doors, could be a portfolio, based on the rental income of that property, not the landlord's ability to pay, the property's ability to pay. We take 2 points. We give you a 30-year fixed, maybe 8%. What is that? 1.5 points above a Fannie and Freddie conform mortgage. So it's actually pretty good terms. We're competitive. But since we have underwritten that and it's 8% instead of 6.5%, big pension funds are buying these from us. And they're paying 2.5 to 3.5 points. It's a competitive market. There are 50 buyers of these loans. So let's do a little plain arithmetics here. If you get 2 points first, then you issue a loan that we have, and then you get 3 points after that. What's 2 plus 3? 5. If we recycle that and sell that loan within a month. Right now we're at 45 days average and it's coming down. So let's just, for the math's sake, make it easy. Then we make 5 points per month. 5 times 12 is 60. So that's a 60% annualized return on that loan. But the landlord sits with an 8% fixed mortgage rate that the banks didn't want to provide. Next slide, please. Why I encourage you to consider investing with us. We are so bullish on this. And the first part you should always do, I know I'm a little preachy with that, but when you do your due diligence, ask if your GP has skin in the game. We're raising $30 million first. We're about halfway there. We took 2.5. You get a pref as an investor. We make 0. We're capitalized. We're going to run this company and pay the pref. We don't make any money. It's fine. We're still going to run it. We're so bullish on that. We want to share the upside. The other thing that is here is really cool is that if you subscribe and invest with us here now in May, your money goes to work June 1. Mid-July, are we going to tell you how much you did? And it's going to probably be between 1.5 and 1.62%. Very small spread. That's what you're going to get. And we pay you the week after. Cash. Or you decide through the portal, you just flip the switch if you want to have that reinvested or not. And I know that there are some quants sitting here, I'm sure. So it's like, okay, if you're tracking at about 20% net, if I'm getting the cash, if I'm reinvesting and compounding monthly, it's about 2 points higher. So money is happening right away. It's immediate. And I didn't put that on the slide here, but what I wanted to say in closing here, this is very important for us why we invest in this and what is important for us. We want to invest in America. We have futuristic AI investments and things like that as well. But we're very much here and now, and money can be kind of boring. But we want our money and the money that we are stewards of to actually go to work for America. We can produce this kind of return while we can make a buck to our investors. Yeah, we have an investor right there, sitting and smiling and waving. You could talk to him. Marty has trusted us with some of his retirement funds for this. So we win. 20% is pretty good. Even if we were to track a little lower, if you get 18, that's still pretty impressive. But we create jobs. These are not shark loans. I told you what the terms are and how we make the money. These developers that get money from us, they hire plumbers, electricians, people digging holes. It's a lot of real jobs. Right in Kansas, Wyoming, Omaha, Eastern Colorado. And we provide beautiful housing that families are sitting and having dinner on Friday nights. So that's what I wanted to say. I think we came in and landed this thing with a couple of minutes to spare, 5 minutes to spare. So I would love to take 5 minutes worth of questions, if I may, then.
Thank you. We actually have been very bullish on private credit since 2022, and it's been amazing. And I had the pleasure of speaking with you yesterday. So you have your own underwriting team that actually goes quickly and cranks through the underwriting to actually write out those loans. And
Yes.
at the same time, you have the relationship on the other end with the buyers to buy those loans out.
Yes, it's basically three things that the operation really does. First is to find the projects to actually lend to. 70% of the borrowers are repeat customers. We're only in places where we actually know the market very well. And the people out there originating these loans and basically shaking hand and say, yes, we can do it, they're not even commissioned. They're actually being paid of the long-term success and the long-term repayment of the loan. So that's number one. The next is the actual underwriting. Yes, underwriting is done in-house, and that's why we know what we're lending to, and we can do it in typical 10 days. We can even do it in 5 days if needed. That's how fast we can do it. That's why we suck less than banks. And then the third thing is for the loans that don't stay on our balance sheet, those landlord loans. Yes, there are 50 buyers in the market in the US for buying them. You know the big players there. We have direct relationship with 10 out of them. So we just sell these loans, and it's competitive, and that's why we're getting paid for that. Thank you.
Thank you.
How large is the fund, and what's the minimum investment?
Thank you. We can actually, yes, here we go. So first of all, maybe I forgot to say that, so I want to do that. You have to be an accredited investor to invest in this. We are Reg D 506C compliant. The minimum is 100K. As of end of April, we had $105 million in outstanding loans that were on our balance sheet. We also have about $50 million of, they're called DSCR. Those are the loans that we underwrite as fixed mortgages and then resell. The volume of those goes up and down very quickly because as soon as we can, we try to sell them and we issue them as we can. So 150 combined is current state.
So if the money you put into the fund is non-retirement funds, am I going to have taxes each year on the sale, or the closing of because they're 6-month loans? So is there a gain each year that you have to recognize?
Yes, let me clarify though. It has nothing to do with our loan terms for the
Yeah.
operations, but yes, you are getting a K1. So this is income that you have to pay taxes on, regardless of if you reinvest or you take the cash out. We achieved what's called a REIT status early 2025. We're currently right now here in June going to have an audit done, and then the CPAs are going to issue the K1s for that. And at that point, are we going to know exactly what share of the K1 that is going to have REIT status, where you get a 20% discount on that. So it's going to be more than 0%, but I do not want to speculate on exactly how much that is. But yes, it is ordinary income with the caveat that some of it is going to have REIT status. That's why many of our investors, this has been a very typical thing. When people hear about this, they first, oh, that must be risky. And then I actually explain what it is. We've never lost money and how it is. And my money's in there and all this stuff I talked about. It's like, okay, I'm in. A lot of people put in $100,000 or $250,000 to start with because that's what, available liquidity. But for us, in full transparency, that's not what we necessarily the end game we want. We want that, and then we want these retail investors to actually put their retirement funds to work. Because we are a little bit on a mission on this, where I personally think this whole 60-40 model is pretty absurd. And I think it's absurd that you've been taught since you entered the workforce to save away in a 401k. And then hopefully you stack up enough money, and then you should start burning that pile down and hope you die before you run out of money. That's a little weird to me. I would like to have a big stockpile of money where I can live off of the yield, so that the money that I put in there can survive and go to others, and I can live a happy life on my retirement fund. So that's, for us, a lot of the growth journey, and that's where most of our retail investors are investing a small amount, and then they're putting their retirement funds to work with us. Yes, sir.
Do you have a UBIT blocker for retirement accounts?
This is a tax liability question with UBIT. I don't know. We can't get into details on that. We are not exposed to UBIT for this, so we are protected from that. So let me just put it that way. We don't need a blocker. This is considered interest income. Yes, sir.
So there's something called Flywheel from a company called groundfloor.com. Is this very similar to that?
Something you don't hear me say often, I don't know. I'm sorry, I don't know what that is. So I cannot make a comparison. I'm getting the signal that we're done. My name is Erik. Would love to talk to you guys about this. And we are open for business and would love to welcome more LPs to join us on this and create some jobs and homes in America and beautiful returns for you. Thank you so much.
Thank you, Erik. Great job.